Hello, hello, hello. Good morning, good afternoon, good evening for some of you. My name is Peter Walker. I am the head of insights here at Carta. Really appreciate you joining us this morning as we discuss what is going on with pre-seed fundraising for early stage startups. And I've got two people joining me today that are some of the best in the business when it comes to this sort of analysis. We'll invite Jeff Becker from Antler up on stage first and foremost. Jeff, how you doing?
Hey, Peter. Thanks for having us.
Absolutely. And then, of course, my friend and yours, Haley Bryant of Hustle Fund. Haley, how are you?
Hey, Peter. Doing great. Thanks for having us.
Absolutely. Haley, you are a returning guest, champion, one might say. Jeff, first-time contestant, so hopefully this goes well. All right, so everyone, today the plan is to jump into a little bit of data on what's going on with pre-seed fundraising. We can obviously discuss what the heck the word pre-seed means because everyone has a different definition of that. And then we're just going to have a live conversation about the most important trends happening in this part of the startup market. I'll flag at the front, there are hundreds of you submitted questions before this event. We really appreciate those. We're not going to be able to get to all of them. I've kind of bucketed them into thematic categories that might be helpful. But if we didn't get to your question, please, please, please go ahead and shoot me an email, peter.walker@carta.com, and I will try to get to as many of those as I possibly can. All right, so with that, I'm going to go ahead and start sharing my screen and we'll walk through some of this data. It is. Navigating through screens here.
Peter, you have a great radio voice.
He does, right?
I just realized.
So nice of you. As someone who actively has to listen to myself talk on various live events pretty often, I think I would disagree, but appreciate the compliment. All right, pre-seed fundraising, Q2 2024. Let's dig into it. First off, when we look across the entirety of venture capital, 2023 and even the beginning of 2024 was nobody's idea of a fun time. This was a pretty difficult market to start fundraising in. But if you narrow it down to just investment that's happening on SAFEs or convertible notes before any priced rounds. So this isn't technically all pre-seed. I'm sure some of you would call this, some of this is seed, some of this is maybe even angel rounds, et cetera. But just in this early part of the market where fundraising on SAFEs, things haven't been so bad. I mean, about $1 billion or so is invested into Carta companies on these instruments every quarter. That was a little bit lower in Q2 of 2024, but I kind of expect that number to bump up a little bit as the data lag resolves itself. So in general, I think that this is actually the most active and lively part of the venture market, even though I know it probably doesn't feel that way to all the founders on the call. So I don't know, Jeff or Haley, have you found like a big difference in terms of the round velocity or just the general activity level so far this year?
Yeah, go for it.
Sure. So it's been a busy year, surprisingly busy, and through to this summer as well. One of our GPs, Eric, went viral, I think a few weeks ago, commenting that all of the VCs are on their yachts over the summer, so wait to raise until the fall. It's always been pretty busy. The pre-seed and seed stages have both been relatively insulated from the pullback of the last few years, at least relative to the later stage round. So we're still seeing a lot of companies raising. It does seem like there's a flight to quality, more consensus rate deals getting done that maybe have certain stereotypes about them, whether that's they're in AI. I think CB Insights found that 28% of all capital deployed last quarter went into AI startups, or they have certain backgrounds. So I think there are certain deals that are getting done a lot easier. Maybe things are happening a bit slower, but still a lot of interesting and exciting volume at this stage. What are you seeing, Jeff?
Yeah, no, likewise. I'm actually surprised to see that the total dollar amount here from Q3 through Q4 is staying the same with the number of companies coming down or number of SAFEs being written. I guess that would signal that angel checks are being written in larger amounts. But overall, like on the ground, it feels like it's incredibly active. I'm seeing a lot of people catalyze their rounds with angels, advisors, lots of small SAFEs. So, to see that actually SAFEs on average are going up in size relative to volume is pretty interesting to me. but it feels incredibly active, more so than it did end of last year, the beginning of last year, for sure.
Yeah, I think that the activity that's reflected in this data is perhaps not entirely indicative of, as you all mentioned, sort of the general sense of urgency that seems to have come back into some of this part of the market. When I speak to founders a lot, they are also telling me, like, look, the fundraising process might be taking longer, but it feels like everyone is out meeting. And even as Haley mentioned, if it happens to be from a yacht in Lake Como, that's one thing. I don't think that's most investors, especially not at this early stage. So we can give investors a little bit of a break. Fundraising in August was okay. I promise they were answering emails.
From the founder side of things, not just the investor side, I think founders usually use the summer as an opportunity to have a not fundraising cycle, to actually go out and build relationships, talk with folks, understand what kinds of great investors would be good culture fits on their cap table, hiring investors rather than pleading with them to invest. And so I think you have this relationship development that goes on over the summer that leads into what becomes a very busy kind of post-Labor Day sprint towards deploying in Q3 and Q4 as, the vintage comes to an end. So maybe we're seeing, activity in the sense of number of meetings, but not checks. I don't know, Haley, if that's what you're seeing, but there's definitely a lot of not fundraising going on, even though people are out there trying to get capital in the door.
Yes, the non-fundraisers are very active. I would agree with you. We're seeing a lot of companies are kind of thinking about the trade-off between being one of the, say, 100 companies in market and being at the top 1% of that versus being in the top 10% of the top, say, 1,000 companies in market come September. Yeah. So we have seen some interesting rounds get done very quickly this summer. Really has to come back to first principles, like where is there velocity in your business? Where can you build momentum to get people excited about getting on a call with you? And we have seen several rounds within our portfolio and beyond get done very quickly, despite it being that slower time.
Yeah, and at Antler, just to put some numbers on it, I did 8 investments in January, 7 have already raised. I did another 11 in June, and 9 of those have already raised. So It does feel like the velocity is there.
That's I love it. Encouraging, optimistic signs here for the latter half of 2024. So for all of you on the call, again, when we talk about pre-seed, the way, and many people have different definitions here, one of the key criteria that we use is these are not priced rounds. So we're not actually considering any priced round funding that happens, even though some of those priced rounds might be small enough that people would consider them pre-seed. In my view, it doesn't really make sense these days to do a priced round if you're raising, less than really $2 million or more dollars, honestly. And we kind of see that reflected in the data. But between the two types of dominant pre-seed vehicles, you've got SAFEs and convertible notes. There's really no contest anymore, at least across the data we're seeing. SAFEs have come to dominate the market. It's something like 80 to 90% of all the dollars and rounds that we see invested into these early companies are happening on SAFEs versus convertible notes. So if you're not familiar with the SAFE, I highly suggest you start becoming so, because that's probably where you're going to raise your first capital. And when we talk about the kinds of SAFEs that are happening, I actually saw this as a question in the chat. When we break it out by round size, you can see that I think this is a really easy chart to see the distinction between boom times in early 2022 and today times in 2024, where it used to be that maybe these really, really large SAFE rounds, like 5 million, 3 million, et cetera, were happening more frequently. But now you've got rounds that are under 250 to maybe 500K as the biggest segments. That's going to change a little bit because some of those rounds that were just recently raised are currently under 250, but they'll probably get over 250 by the time they're done raising. SAFEs are, happen on a rolling basis. So sometimes it's kind of tough to say when did the round happen, because it might be 3 or 4 months between fundraising. But in general, I think the rounds have gotten a little bit smaller, although just more focus is happening across SAFEs, from the tiniest part of the angel market to like really, really big SAFE rounds that you might read about in TechCrunch that would have used to be price rounds a couple of years ago.
It's a great marker of the capital efficiency that we're seeing in the market right now. And I think this is an expectation for many VCs that founders will be able to do a lot without having to invest a ton of money, which is great in terms of dilution for founders, for investors over time. But I think we'll continue to see this trend over the next couple of years.
On that capital efficiency point, though, Haley, just to jump in there, is do you think founders have internalized that to the same degree as investors have come to expect it? If that question makes sense.
It's a good question. I think anyone who was out in the market in early 2022 onwards to fundraise has been, they've heard the drumbeat around the importance of capital efficiency, meaning that you are very efficient with the money that's invested in the company, maybe hiring fewer people, and just burning less overall. I think this is a big question from lots of early stage VCs. We're having more people ask for models earlier in the journey, data rooms. Right. To understand thinking and how money will be deployed. It is different coming to market now as a founder. So if you're just gearing up for your first raise, there is generally an expectation from VCs that you're keeping your burn multiple. There's a great article from Craft Ventures on that at a reasonable number, so that you're being really efficient with the capital that you have.
Yeah, for sure. I mean, I think two things to call out here. One, if you're in 2022 writing, $5 million plus safes, and you walk into 23 and 24 and don't have a board seat, and your company's not capital efficient, your LPs are not happy with you, right? And so deploying that much money on a safe with no ownership, or voting rights, or some level of control over that, I think that's a big risk, and I think that's why you see that coming back down. We'll still continue to deploy safes at smaller amounts. But when you're writing bigger checks, I think you need to have some ownership or stakes that you can have control. Think about crypto boom, how much money was flying out the door on safes was quite wild. And then to Haley's point, I think capital efficiency is an interesting topic. You have kind of two camps in venture. Let's call it like Eric Paley, founder collective camp. If you read his tweet threads, famously invested $7 million in the trade desk, and that's all the money they ever raised and went public for $40 billion. Highly capital efficient. He talks about the atomic unit of the business, either compounding exponentially or compounding to zero, and really understand the capital efficiency that Haley was talking about and the burn rates. But you still have a lot of venture capitalists that believe in blitz scaling too, right? Yeah. Where tons of companies are out there buying market share and trying to build consensus on a non-consensus idea. And I think that goes back to the point of investor-founder fit on the cap table, interviewing these people, building relationships over the summer, trying to figure out when someone joins my board, are they going to be thinking about this business the same way I am and want me to spend money in the same ways that I want to spend money? And so having that time with investors to understand how they operate, how they think about spending money, how they think about raising subsequent capital. I don't think either one is perfectly right, but it is a style choice on, do you want to put the pedal down or do you want to, go slow to go fast?